Welcome. Over the last 7 sections, you watched inventory move through procurement, costing, manufacturing, variances, valuation, and finally sale. Now we close the loop by looking at how every one of those movements lands in the general ledger. Inventory generates more journal entries than any other asset on the balance sheet, and in this section, we group all 16 of them into clusters so you understand not just the debits and credits, but the principle behind each one. By the end of this section, you will be able to explain why inventory generates more journal entries than any other asset, and why every physical movement has a matching ledger entry. You will record the entries that bring goods in and capitalize their cost, the entries that accumulate cost in production, and the entries that complete and sell the product. You will apply the variance entries that reconcile standard to actual, and you will identify the loss and adjustment entries for spoilage, write-downs, shortages, and goods in transit. Here's the key thing to hold on to before we touch a single debit or credit. Inventory sits on your balance sheet as an asset, and it stays an asset until one of three things happens to it. When it sells, its cost moves to cost of goods sold. When it is lost or damaged, its cost becomes an expense. And when its value drops below cost, you write it down. Everything else, the differences between what you planned and what actually happened, lives in separate variance entries booked at period end. Keep that map in mind, and all 16 entries will fall into place. Our first cluster is about getting goods onto the books at the right cost. The principle is capitalization. When you buy raw materials or merchandise, you don't just record the invoice price. Entry 1 debits raw materials or merchandise inventory for the full landed cost, the purchase price plus duties, freight, and insurance, and credits accounts payable. Entry 2 handles import duties and landed costs separately, debiting raw materials inventory for the amount incremental to per unit cost and crediting duties payable or cash. The reason this matters is simple. If you expense those add-on costs instead of capitalizing them, your inventory is understated and your margins are wrong from the very start. Once materials leave the storeroom and hit the production floor, they stop being raw materials and start becoming work in process. Entry 3 captures that movement. You debit work in process inventory materials at standard cost as defined by the Bill of Materials, the BOM, and you credit raw materials inventory. In practice, this means the cost physically follows the material. Notice we record at standard cost, not actual. That's deliberate, because it lets us measure usage against a benchmark later. This entry begins the accumulation of cost inside work in process, and the next two entries add the rest of the manufacturing inputs. Production needs more than materials. Entry 4 applies direct labor, debiting work in process inventory, direct labor, at standard hours times the standard rate, and crediting accrued wages or salaries payable. Overhead is trickier because you can't trace it directly, so it comes in 2 steps. Entry 5 records the actual overhead you incur, debiting the manufacturing overhead control account for real costs like rent, depreciation, indirect labor and utilities, and crediting cash, accounts payable, or accumulated depreciation. Think of that control account as a holding pen. It collects the actual spend, and in the next entry we push an estimate of it into the product. Now we put overhead into the product. Entry 6 applies manufacturing overhead to work in process using the predetermined overhead rate, the POR. You debit work in process inventory overhead for the POR multiplied by the actual allocation base consumed, and you credit manufacturing overhead applied. The surprising part for many people is that this applied figure is almost never equal to the actual overhead sitting in the control account. That gap, applied versus actual, is exactly what we'll have to clean up later when we dispose of the overhead variance. For now, work in process holds materials, labor, and applied overhead, and it's ready to finish. When a batch is finished, its accumulated cost has to move out of production. Entry 7 transfers completed production from work in process to finished goods, debiting finished goods inventory for the cost of goods manufactured, the COGM of that batch, and crediting work in process. Then comes the moment the whole cycle has been building toward. Entry 8, in a perpetual system, records cost of goods sold at the point of sale. You debit cost of goods sold and credit finished goods or merchandise inventory at the cost determined by your costing method. This is the entry that finally turns an asset into an expense, matched against the revenue it earned. Because we recorded materials at standard cost, the differences from actual become variances. Entry 9 isolates the material price variance. When the unfavorable case occurs, you paid more than standard. You debit raw materials inventory at the standard price, debit material price variance for the unfavorable amount, and credit accounts payable at the actual price. Entry 10 handles the material usage variance at period end. When you used more material than standard allowed, you debit material usage variance and credit work in process inventory, removing the excess cost at standard price. These two entries keep your inventory clean at standard while parking the performance gaps where managers can see them. Remember the gap between actual and applied overhead from Entry 6. Entry 11 disposes of it at period end. In the underapplied, unfavorable case, you debit manufacturing overhead variance for the underapplied amount. Now the treatment depends on size. If the amount is immaterial, you simply credit cost of goods sold and close it there. If the amount is material, you credit cost of goods sold along with work in process and finished goods inventory, allocating it proportionally across all three. Why the distinction? Because a material amount belongs partly to inventory still on hand, and dumping it all into cost of goods sold would distort both your margin and your balance sheet. Not everything that enters production comes out as good product, and how you treat the loss depends on whether it was expected. Entry 12 covers normal spoilage. Here's the surprising part: there is no separate entry. Normal spoilage is absorbed into the cost of good output because it's already baked into the standard cost per unit. Abnormal spoilage is different. Entry 13 treats it as a period expense, not a cost of inventory. You debit abnormal spoilage loss as a period expense and credit work in process inventory to remove the cost of the abnormal spoiled units. The principle is that only expected, unavoidable loss belongs in product cost. Unexpected loss hits the income statement immediately. When inventory's value drops below its cost, accounting won't let you keep carrying it at the old amount. Entry 14 records the write-down to net realizable value under the lower of cost or net realizable value rule. LCNRV, you debit inventory write-down expense, or cost of goods sold, and then the credit depends on your framework. Under International Financial Reporting Standards, IFRS, you credit an allowance for inventory write-down, a contra asset that can be reversed if value recovers. Under United States GAAP, you may credit inventory directly. Either way, the principle is conservatism. You recognize the loss in value as soon as you assess it, not when you eventually sell. Two final adjustments close the cycle. Entry 15 handles a physical count shortage, the case where your book quantity is greater than what you physically count. You debit inventory shrinkage expense or cost of goods sold and credit inventory, bringing the records back in line with reality. Entry 16 recognizes goods in transit at period end, inventory where title has already passed to you even though you haven't received it yet. You debit inventory, goods in transit, and credit accounts payable. Without this entry, your inventory and payables would both be understated, simply because the truck hasn't arrived. Title, not location, decides ownership. Let's pull it all together. Inflow entries capitalize the full landed cost, so inventory starts out at its true value. Production entries accumulate materials, labor, and applied overhead in work in process, then transfer finished cost to finished goods, and finally to cost of goods sold at sale. Variance entries reconcile standard to actual at period end, and dispose of over or underapplied overhead by materiality. And the loss and adjustment cluster, abnormal spoilage, write-downs, shortages, and goods in transit, keeps inventory honest by routing lost value to expense and respecting that title, not location, defines ownership. Thank you for completing this section on the journal entries of the inventory cycle.